Good morning, Jags. This is Fahad. Today is Monday, January 4th. It's the first day of the year, and the first stock I have for you to discuss on this day is Johnson & Johnson, symbol JNJ. Um, a couple things to note. This stock is starting to break out on both daily and the weekly scale after a long period of time. So if you can see, this has come up to this $155 resistance multiple times throughout the entire year. So this was in February, this was in April, and then try it again in September, try it again in October, and then November, and then finally in the final 2 days of the year, it started to finally break out and ended up closing at $157 per share. And as I've said many times, the bigger the base, the higher in space. If you look at the weekly scale, you will see the significance of this. This is the 3-year chart, and here is a 5-year chart. So even on a 5-year scale, you can see if you go all the way back to 2019, this stock struggled to hold above 150. Same thing with 2018, multiple times there, it struggled to hold above 150. So really, this thing has been in formation like this for more than 3 years now, and it's finally starting to clear through all of this congestion and resistance level. And as a result of this, what has happened is that when something basically goes into consolidation phase so long, while the growth remains positive, the multiple contracts to a point and the dividend yield rises to a point where it becomes very attractive for money managers because it basically falls to a trough level. And so anytime when you start to see rotation into the sector that the company is in this case, healthcare sector, that's when you start to see some outperformance come into play. Now, with that said, late last week in the chat room, we pointed out there was unusual call buying took place very late in the session in Bristol Myers BMY, right? That's a healthcare stock, large pharmaceutical companies, and as well as Gilead Sciences, GILD. Now, these stocks do not usually perk on my screen with a lot of option activity, but maybe that was a hint or a glimpse that potentially going into 2021, where we should see expectations of outperformance, would be in the healthcare sector, which performed terribly in 2020. We discussed that multiple times. If that continues and we continue to see sparks in the healthcare sector throughout today and in the first 2 to 3 weeks of January, then that's a sign that potentially the money managers are rotating into this sector, and that's where you would look for some alpha, at least at the start of the year, that could potentially set the grounds for the remainder of the year too. As many times goes, many times people say that the way January goes, so goes the entire year. So whatever is going to outperform materially in this month is potentially going to continue for the rest of the year, even if we get some mid-year modest pullbacks and such. So Johnson & Johnson is on my watch list to benefit from that, given the technical picture. I would also like to point out that on December 30th, so while we were enjoying the holidays and the new year, Credit Suisse was out with an interesting note after doing some channel checks or mid-quarter channel checks. And they say, I quote, Johnson & Johnson major U.S. pharma franchisees appear to be tracking $139 million above our estimate for the fourth quarter, or 4 cents of theoretical EPS upside versus the consensus view based on our channel checks. This equates to 14% growth year over year for earnings per share versus our estimate of 11% growth year over year. Therefore, we are reiterating outperform rating and $168 price target for Johnson & Johnson. So there you go. Revenues are tracking $139 million for the fourth quarter above consensus, and earnings per share is tracking 4 cents above the consensus, which equates to 14% year-over-year growth rate versus 11%. That's a read-through from Credit Suisse based on their channel checks, and I think that supports a potential beat and raise once this company reports earnings in a couple of weeks. So that's a quick view on Johnson & Johnson. Second thing I would like to quickly discuss is semis, SMH. There's a very interesting strong rally that is shaping up in pre-market, and this is really translating from what we saw in the overnight session in Taiwan, in South Korea, and many other places. So if you look in pre-market, you will see that, for example, Micron is guided higher after a strong close on last week. Micron is guided higher by about another 1.5%. And you can just really go down the list. Here's Taiwan Semi, closed at around $109 per share. It's going to open up at $112 per share. LRCX, right, which is another memory name. This is about 0.5% higher in pre-market as well. And then just go down the list. ASML, another name that we really like, closed at 486, trading at 498 in pre-market. So now nearing $500 per share. And then one of the names that we really like, this thing is sharply rising in pre-market, which is STM Microelectronics. STM is the symbol, closed at 37.12, trading near $39 per share. So this thing is up 5% or more in pre-market, and is making a major entry into this gap over here. Interestingly, what we are seeing is there's a bunch of news that's out in the sector, but the most important one is the month of November. Semi-Industry Association channel checks, or SIA, it goes by. The SIA reported, this was on January 3rd, so basically yesterday, the SIA reported November total semi revenues of $38.7 billion year over year globally, which was up sequentially month over month by 2.6% and year over year by 8.1%. This is a significant beat versus consensus estimates, as well as the normal seasonality we see during this period of only 0.4% increase sequentially month over month from October to November, but we are seeing up 2.6% right now. Memory was the strongest of all, led by a 9.3% increase. And within memory, the SIA points out that DRAM bit growth prices, which increased by huge 18.9% month over month sequentially from October to November, which is well above the normal seasonality that we see of 10.2%. And on a year-over-year basis, the memory bit growth is now up 23%, and just continues to tack on to them. Similarly, we saw the NAND prices also accelerate to 11.2%, which is significantly above the normal seasonality of 3.9% increase that we see from October to November. This is hugely positive for Micron. This is positive from Lam Research. This is positive for all of these memory stocks. And as a reminder, if you go to Micron, Micron will actually be reporting earnings this week on January 7th after market close. January 7th is Thursday after market close. So I'm expecting a very strong quarter from this company, and whatever Micron says is also positive for Lam Research, which has slightly pulled back and should be the beneficiary of these strong trends. So that's it from me. Semi-sector as well as a bullish play on Johnson & Johnson. I expect this stock to get to about $170 per share in coming days. That's it from me, Jay.
Morning, everyone. So today, looking at a relatively new company called Hydrofarm Holdings. Ticker is HYFM. Not much to see on the chart as it debuted last month on December 10th. Priced its IPO at $20 per share. Hydrofarm is one of the largest independent wholesaler and manufacturers of hydroponic equipment and grow lights in North America. Its main competitor right now includes Hawthorne, which is owned by Scotts Miracle-Gro, SMG. Hydrofarm, their net sales, approximately 2/3 of their net sales relate to recurring consumable products. So that includes growing media, nutrients, and supplies that require regular replenishment. And the remaining portion of their sales relate to durable products such as hydroponic lighting and equipment. Now, I'm going to have a more in-depth write-up on the homepage most likely later today. So I'll talk more about the industry, more about this company in general. But looking over some of the initiation notes from this morning, there was one comment from Stifel that just caught my attention. They had said, "We recently had conversations with investors who first considered investing in this company during its 2018 financing rounds, and then again in the December 2020 IPO. From these discussions, we noted a sea change in the perception of the company's capabilities, outlook, and approach. And reading further into it, in my opinion, one of the main reasons why I think you're seeing this change in perception is because of the current CEO, Bill Toller. And that's because he has had success in the consumer space. For example, he led a turnaround at a company called Advanced Pierre Foods following their Chapter 11 bankruptcy. He rebuilt Hostess brands following their Chapter 7 bankruptcy. And so when he came into Hydrofarm in early 2019, he optimized their supply chain. He executed a strategic SKU rationalization program. He prioritized the more profitable proprietary and preferred brands under the company. And so as a result, these efforts have yielded 600 basis points of gross margin expansion. And then in Q2, the company returned to profitability. So a lot of the success this company has had is because of the current CEO and his knowledge of the consumer space. So like I said, expect a more detailed write-up on the company later today on the homepage.
This is very similar to Grow Generation, GRWG, isn't it?
Yes.
Okay, because when I see hydroponic, that's
Yeah.
that's what comes to mind, and this has been a huge winner for all the JAG clients. I mean, just a monster chart that just never wants to pull back. Now, I'm just reading high level over here. The Hydro Farm revenues increased by 40% year over year for the 9 months ending September 30th to 254 million. Interestingly, on a purely valuation basis, this company actually seems to be cheaper, far cheaper than Growth Generation, perhaps because this is a newcomer with the IPO that just came to the market, hasn't really caught the momentum like Growth Generation has. But the growth rate is similar in fashion, maybe maybe within 5 to 10 percentage range of the delta versus Growth Generation and the same industry. So looking forward to your article, I think that this could be an interesting one to trade, especially once it has options available.
Definitely.
Chronicle.
Good morning, everyone.
So I have, by the way, just to quickly let you know, I have your write-up, slide deck, and everything. So let's do that presentation later today. Hopefully we can publish it then before the market closes.
Sure, sounds good. Happy New Year, everyone, by the way. So I've been going through some commentary on 2021 themes from sell-side and hedge funds and also on Twitter. One common theme that I'm coming across is that many people have this expectation that beneficiaries of COVID-19 are going to start facing difficult comparisons this year, which tells me that this is very much a consensus view rather than contrarian. Not that I'm saying it's wrong. But with that in mind, I think right now, one question that's not being widely asked is whether there are any COVID beneficiaries that are going to see even more accelerated growth in 2021 rather than succumbing to tough comparisons. Because if we can start identifying such companies right now, then we are possibly looking at a pain trade of sorts where people are expecting the stock to fade, but then the company surprises people by posting another strong set of numbers. And on that note, a couple areas that I think are going to continue seeing strength are online education and remote education technology. Because looking ahead, I'm anticipating that the number of college applications and resulting undergrad admissions for this year to go through the roof. Because what's happened is we have a lot of prospective applicants who have delayed applying to colleges and universities last year due to COVID. And currently, the latest checks show that applications are still down almost 10% year over year, which is an improvement from negative 26% back in October. So I think as this year progresses, application numbers are going to come back with a vengeance because people can only put off their education for so long. And I'm not talking about just domestic students here. I'm also talking about the vast numbers of international students who have delayed their applications to North America and Europe, and to a certain extent, Australia. In the US, I think international students represent something like high single-digit percentage of student population, but it's really their higher fees that make up for it. So I have several close contacts in the private education business here in Asia, and what they're finding is that the available slots for proficiency tests like the SATs and the IELTS, in several countries, those slots are now fully booked through the first half of the year. And this is evidence that international student applications are likely to surge for the fall. And then with universities having missed out on a lot of revenue last year, I think what we're going to see with at least some admissions offices outside of the Ivy Leagues is perhaps a loosening of standards with an increased intake. And because we're still going to have some form of social distancing for at least a semester, while at the same time there's a high number of freshmen coming in, this combination is going to make demand for online education more relevant than ever. And also, I think we're going to see an improvement in demand for online assignment passes and keys, which are sold by publishing companies like John Wiley and Pearson. Now, in terms of companies I'm looking at Jaguar, we've liked Chegg for a long time, but for the next JaguarMedia video, I'm currently looking for possible smaller companies that could offer higher beta and more potential upside than Chegg. Right now, I've already shortlisted 3 companies I'm about to take a closer look at. And then the next step for me is to narrow this down to 1, for which I'm going to prepare a JaguarMedia presentation. I'm not going to reveal the companies on my shortlist because I haven't committed to any of them yet, but once I decide which one to go with, I'll be sure to preview it in advance.
Sounds good. Yeah, Chegg has been our favorite for quite some time. You know, there's one thing that I will just say on the high level standpoint when it comes to college education in the US. And this is not a political statement. This is simply a hard fact. Anybody that wants to look at the data, they can just pull the data and see themselves. But in the past 4 years during Donald Trump's administration, we saw the college admissions in the United States for foreign students basically started to decline as soon as he took the office, starting from 2017. It was flat. Then after that, it started to decline in 2017, 2018, and 2019 by low single-digit percentage, as basically with the whole trade rhetoric and everything else, people just put off coming to the US, and instead they diverted themselves to foreign students from Asian and many other emerging economies into places like Australia, other English-speaking nations, Australia, Canada, and many other places. I know this also firsthand because, without going into too much detail, my uncle owns a business that has sent 23,000 students from all over Asia into foreign universities in the developed nations. He's an advisory business, and he works directly, closely with hundreds and hundreds of schools, for student placements, and helping them out with the SAT scores and ACT scores. It's a very well-run business. And he told me himself that throughout the year, he has basically seen the shift mix, essentially change from heavier emphasis on sending kids to study in the United States, gradually preference among parents and students to go for Australia or Canada and many other places. And that has been a trend in the past 3 to 4 years. I wonder if that trend will change starting from 2021 for the better under Biden administration, as basically a lot of this rhetoric will stop, and then we're gradually will see basically more foreign students coming back to the US as they have always desired to. I was a foreign student too. So naturally, if that happens, that has ramifications on many different things too. Plus, the economy will open up as COVID will likely go away, in my view, by summer of 2021. So I do expect a bit of an increase this year in the foreign students coming to the United States, and then much of that focus will remain to be online. And so there are definitely picks in there in this theme that are going to be the beneficiary. We'll find out exactly what Chronicle has in play this time in the JaguarMedia presentation that's going to be coming out hopefully pretty soon. All right, folks, we're going to stop over here. Thank you very much for joining. First day of the year, take it lightly, and most important thing that I can say is that focus on for the month of January, from this point on up until the next 2 to 3 weeks, to see where the market is heavily focused, because if there's going to be taking some profit in some spots and going into certain areas, whatever is going to set the tone for the market in this month, particularly in the first couple of weeks, in terms of sectors, is most likely going to provide the leadership role for the entire year. And pullbacks in those sectors will remain very, very shallow. So that's what you need to focus on as we start in January. Look for outperformance and then focus on that. That's it from us. We'll see you in the chat room shortly.